Hi folks, Denise Howell here, and today on This Week in Law, we're joined by Aaron Wright, professor and author, and expert in all things related to cryptocurrencies and blockchain. Stefan Szpajda is here with me too. We're going to talk about being bullish on ICOs, but only if they're done right. Smart contracts, the good, the bad, and the creepy. CryptoKitties and the past and future of auguring, all next on This Week in Law.
Netcasts you love.
From people you trust.
This is TWiL.
This is TWiL, This Week in Law with Denise Howell and Stefan Szpajda. Episode 431, recorded August 24th, 2018. Turning assets into email. Hi, folks. I'm Denise Howell, and thank you so much for joining us here on This Week in Law. We're very excited to be doing this week's show. We are going to be all about the blockchain and law and policy. And we've got probably the preeminent guest in the world to discuss this with us. Aaron Wright is joining us. He's an assistant clinical professor at Yeshiva University's Cardozo Law School. He's the founder and director of its tech startup clinic. He's the chairman of the legal industry working group of the Enterprise Ethereum Alliance. He's the director of the Cardozo blockchain project. He's the developer of OpenLaw. He's literally written the book on blockchain law, and we're thrilled to have him on the show today. Hi, Aaron. Great to have you.
Hey, Denise. Hey, Stefan. Thanks for having me on. I really appreciate it.
Before I go too far and neglect to tell you the book that Aaron has written on blockchain and the law, it is called Blockchain and the Law, The Rule of Code, and he's co-authored it with Primavera de Filippi. Do you teach with Primavera, or how do you two know each other?
We met just through the blockchain community, and we decided to put the book together. But I have taught a class with Duke Law School this past year. It was great.
Yes, that sounds like it would be really cool. So your law school and Duke partnered up on a class that was for both sets of students?
Yeah, we connected over Zoom and discussed blockchain law and policy. It was really fun. Students really enjoyed it.
That's fantastic. So Aaron knows so much about all things blockchain and the law related, and we're really excited to get into that with him and with all of you. Also, my co-host Stefan Szpajda is here. Hi, Stefan.
Hey, Denise. Hey, Aaron. Thanks for having me again.
Great to have you on. Stefan is an attorney at Dorsey and Whitney's a firm in Seattle, Washington, where he practices intellectual property litigation. And we're just thrilled to have you back, Stefan. Thanks for being here.
Can't wait to learn about the blockchain, because it's something you hear so much about, and it'll be useful to actually be able to say something about it beyond just sort of giggling about how contemporary it is.
Woohoo! Yes, and I should correct my and your usage. It's not the blockchain, is it, Aaron? It is a blockchain, because there are many different blockchains. Is that right?
Right. Yeah. I mean, there's plenty of misconceptions about blockchain technology, but I think the growing consensus is that there's going to be a constellation of blockchains, different blockchains for different purposes that are kind of connected together in various different ways through various different technical systems.
A constellation of blockchains. I like that. One thing I promise not to do to you on this episode of this show, Aaron, is I assume that every time you're interviewed and every time you go on a podcast, people ask you to explain what blockchains are. And I'm not going to do that to you. We have a very tech-savvy audience, and I'm assuming and I'm trusting that they will all be courteous enough to, if they need to have that background, they will go and look it up and then come back. Here's your chance. Take a break from the show. Go look up how does blockchain work and come back and rejoin us, because we're going to dive right into not what it is, but how it works and what lawmakers think about how it works. So let's start right off on the front of legislation, regulation, and policy. I have sort of a framing question for you before we get into talking about specific regulatory issues, Aaron. You pointed to a tweet not too long ago from Matt Liston. And here's what you pointed down to it and you said, here's what I'm working on and for. And Matt said, what if scaling works? Token regulation becomes increasingly clear and permissive of live and legitimately decentralized projects. And a new wave of competent and responsible actors enter the space with revolutionary technologies able to commercialize. And I read that and thought, yeah, I understand how Aaron is working toward and dreaming of that reality. But my framing question for you is, can you see that on the horizon, or is it still really dimly far off?
No, it's definitely on the horizon. I think, blockchain technology is often misunderstood, but I think people increasingly recognize that it is a very powerful technology that has the potential to anchor the next generation of the internet. And the reason it can do that is because it has the hope and the possibility of managing a whole host of real-world assets and virtual assets, which are growing. And it also has the possibility to break apart these massive data silos that we've seen emerge, particularly during Web 2. Which have led to, arguable monopoly power on the part of a handful of technology companies. And we've seen lots of people get excited about it. Some people get overly excited about it, but there are a number of highly competent and incredible developers, really top in class, that are working day after day, solving the tough technical problems that underlie the technology to bring it from, kind of the dial-up era to the broadband era. Blockchain, and I think we're going to see over the next couple of years, as some of the hype kind of dims and as productivity continues to proceed apace, really, really interesting projects emerge. And I think we've already seen some examples of that with token sales and challenges and opportunities to the way that companies raise capital, to the emergence of non-fungible tokens or these digital goods that people are buying and selling. These are really novel and new things that we're able to do because we have this new data structure with unique characteristics that enables us to do that.
Okay, well, let's start on the front of token sales, since that is much in the news and has been very frothy over the past year or so. One of the pieces in our rundown for today mentions that ICOs, initial coin offerings, have raised something like $9 billion just since this phenomenon started to hit scale a little over a year ago. So that's quite a lot of growth in quite a short amount of time. And if you're paying attention to the technology industry, technology law, you know that ICOs are everywhere and that regulators are scratching their heads how to treat them. And they can be orchestrated in so many different ways, right? What ICOs tend to do is issue a token, something like Bitcoin or Ethereum, but its own private token, as a generally as a fundraising effort for a startup. Correct, Aaron?
Right. Yeah.
And they can do it in many different ways. And how they do it, it turns out to be really important. Why don't you sort of describe that landscape for us?
Yeah, sure. So, one incredible capability of blockchain technology is that you can create something that's like rivalrous digital goods, in the sense that you can create a finite amount of a digital good and you can allocate that. And a blockchain can keep track of who owns that good at any point in time. It can also represent other assets, and that could be something like an uncertificated share of stock or a right to some sort of profit in an enterprise or a company. And what we've seen really starting in 2016, picking up a bit in 2017, and then exploding in 2018, is the ability for folks to raise capital via blockchain. And it's a pretty small little smart contract, or a small computer code that's a bit of computer code that's running on mostly the Ethereum blockchain, that enables folks to effectively engage in a global sale or a global fundraising effort through using blockchain technology and through other means. And what we've seen is that over $9 billion have been raised via token sales in late 2017 and into 2018. We've seen a little bit of a dip in terms of the total amounts being sold, but it looks like it's still chugging along. And the reason for that is effectively what blockchains have done with, again, a little bit of smart contract code, is put an investment bank, a Kickstarter, or other fundraising mechanisms in the pockets of everyone, where you can engage in a sale that takes a mediocre programmer about a weekend to put together. So in much the same way that we saw with the internet, the widespread challenges related to the dissemination of communications and copyrightable material across the internet, we're seeing a similar phenomena, but this time in the context of securities laws and assets. And the big question becomes, what are these assets? Are they digital goods? Are they commodities? Or are they securities? Are they being used for fundraising purposes? Are they being bought because people expect to make a profit off of them? If it's the latter, then we know securities laws apply, and those are very tricky laws. If it's the former, then commodities laws and other laws may apply instead. So that's the big debate. We've seen a tremendous amount of interest on the part of regulators in trying to sort through these issues. We've seen the SEC issue a number of statements from senior officials. You've seen them reportedly issue 80-plus subpoenas to various different token projects. And we've seen similar activity occurring in jurisdictions around the globe, including Switzerland and Singapore, which have provided much clearer guidance, and other regulatory efforts, even at the state level in the U.S.
Right, and I would just add to that, we've also seen law firms starting to build out their own practice areas to help people accomplish ICOs in this wild regulatory rest. I wouldn't be surprised, Stefan, if your firm has some sort of ICO practice at this point.
I'm sure we have great attorneys doing ICO work. It's not something that I personally work on and can't speak much to, but it is something that you hear more and more about, and certainly law firms are getting involved.
Yeah, and I think the reason.
Go ahead.
Yeah, the reason they're getting involved is twofold. One is you can charge, because it's such a complex body of law and the questions are so hard and novel, law firms are charging incredible sums of money to provide advice related to token sales, upwards of $200,000 for one of these sales. So it's become quite profitable. The second reason, though, and I think this is the broader point, I think for the first time since the 1950s, we have begun to embark on a new fundraising mechanism that could challenge traditional means of venture capital financing, which obviously has reverberating effects in areas that heavily rely on VC-backed companies and venture capital funds in order to fuel the local economy. So like the Bay Area or parts of New York increasingly, in many ways, token sales and the sale of these digital goods in order to bootstrap a project is quite appealing to entrepreneurs. And it takes the need to raise late-stage capital from Series B, Series C, Series D venture capital funds. It becomes less necessary. You can basically bootstrap your project, find your tribe online, sell them the goods that you intend to provide them, access to some sort of online service. And if that resource is scarce, then presumably the price could increase in value as demand for the service grows, and you don't need to necessarily raise additional capital, which could be helpful, right? We can move companies away from this treadmill of venture capital financing that's led to these kind of viral, hyper addictive, large, consumer-focused internet companies. So I think that's a real possibility and something that's very interesting and exciting, and obviously challenging for lawyers and regulators as well.
Right, and I'm glad you brought up the parallels to venture capital, and we talked a bit, you mentioned Kickstarter as well. I remember having similar discussions when crowdfunding first started to gain such momentum, that again, there was the question of, okay, this looks a lot like someone is investing in the company. Are the securities laws implicated? And so it seems like there would be a strong parallel to crowdfunding or venture capital, but perhaps less so to publicly traded securities. Do you agree?
Yeah, so, and this is effectively what the SEC has said in its recent statements and its enforcement actions. The big test here is a test called the Howell test. It's a 4-part test. And the key area that comes into focus here is why people are purchasing these tokens. If they're purchasing them with the expectation that they're going to profit based on the efforts of the party developing the project, then it's likely going to be deemed as a security and covered by securities laws. If it's being sold to folks that intend to use it or enjoy the online good or service, then there's a decently strong argument that in those instances it should be treated as a digital good, and those digital goods can be freely bought and traded just like anything else. Because there's not a real logical or rational basis to treat something that's a digital good differently than a physical good. If we began to do that, then it would create a whole host of perverse incentives and effects that I think are probably short-sighted, considering that it looks clear that eventually we are going to have these massive, robust digital worlds where people are interacting and buying and selling things on them. We already see that in the video game context. We now kind of have a global platform to see that emerge in over the next upcoming years and decades, over the internet. So really, that was the big question. And one of the big changes that happened towards the end of 2017 and definitely into 2018, it moved away from crypto enthusiasts or blockchain enthusiasts buying tokens in order to play around with technology, develop technology, support entrepreneurs or projects that they liked and wanted to use, into folks that were really interested in buying tokens for their investment potential. We saw the emergence of a host of crypto funds, or what are effectively venture capital funds or hedge funds that trade these tokens, buying them in mass, buying them at a discount, engaging in abusive practices. And that obviously raised the red flag of regulators both in the US and abroad. And so the SEC has looked into it. They have a number of folks that are dedicated to examining this phenomenon. And they've begun to articulate in broad strokes a couple of lines to help lawyers and entrepreneurs and other folks still interested in raising capital through a token sale, and helping them kind of sift through this commodity versus security line. And in broad strokes, again, if you're going to be raising capital from investors and promising those investors a profit of some sort during your fundraising your fundraising period, then it's likely that the token that you're being sold, no matter what you call it, and no matter what the features are that are tied to it, it's going to probably be deemed a security. It also looks like the SEC is amenable to opening up this idea about selling these tokens to end users or consumers that prove that they want to use it in some sort of capacity, or at least attest to that in various different ways, either contractual or otherwise. They may be able to sell tokens directly to those end users and have those end users hold those tokens and trade those tokens at some point in time. And that seems to be the big dividing line. And I think one of the things that really was interesting here is we saw West Coast law firms tried to basically import venture capital financing documents, a thing called the SAFE, or Simple Agreement for Future Equity. They basically lightly modified that agreement to enable venture capital funds and these crypto hedge funds to buy tokens in mass, oftentimes at a significant discount, in order to engage in these sales. And there was a huge number of questions of what that meant for both the entrepreneurs and the investors and the other projects that were engaging in this new instrument. That instrument was called the SAFT. And the SEC has clarified that selling something through a SAFT likely will make it a security, but it opened up the possibility that for broad decentralized networks, these tokens, even though they were initially offered as a security, could trade as a commodity in the future. But there's huge questions about what that means and what it means to be decentralized, and whether or not a court would actually adopt that standard for evaluating whether or not a token could be freely traded after it was sold to investors.
Right, and there would also be the wrinkle whether it's being purchased or being given away. I mean, people are trying to take all kinds of strategies to avoid having their tokens be viewed as a security, correct?
Yeah, so another thing that folks are doing are, quote, airdrops. Airdrops are just basically distributing these tokens to either folks that already have things like Ether, or another way, or in some other way sign up to receive tokens. It kind of feels like the stock giveaways from the 90s. So during the first .com wave, folks would give away stock in their companies for free in order to entice people to use the service. The SEC at that point in time didn't look too favorably upon such a practice. So there's a big looming and open question as to whether or not airdrops in this instance which are similar, kind of like free stockish or free good giveaways, would be deemed securities. So I think that's still an open question. The case law is not particularly clear as to how it would go. My sense, though, is that if it looks like consumers are getting hurt, or if it really looks like it's abusive in terms of its practice, then you could see a regulator raising and flagging that as an issue and or taking an enforcement action of some sort.
It's such a funny area, I'm sure, for the people who practice law and try and advise clients on this, because it is so wide open. The SEC doesn't have any firm law or regulations on this. It will drop little breadcrumbs, such as back in June, Bill Hinman, the director of its division of corporate finance, made a speech at a Yahoo Finance kind of conference, and you went very deep on trying to read the tea leaves of that speech and what it meant. One of the things he said was, if you look at something like Ether, I don't think that that's a security. And he described why, that it in his test, and you've been discussing this, is how decentralized the token has become, I guess, from its issuer.
Yeah, so Bill Hinman's speech was kind of a culmination, at least it seems, of a number of conversations, both with lawyers, academics, private companies that were engaging in these token sales to try to provide additional guidance. And I think you're right to say that the SEC has just been providing breadcrumbs and just trying to provide as much guidance as it possibly can to folks that are engaged in these token sales. And the reason that I imagine they're doing it is because regulators face asymmetric risk. If they provide too much detail, then folks will obviously work around it. They could be put in a compromised position, if everyday consumers and or investors are hurt. So it's a tricky position for regulators to be in because they need to be mindful of giving themselves enough flexibility to kind of catch the bad guys or the fraudsters, while at the same time providing enough guidance to legitimate entrepreneurs or developers that are trying to build this kind of next generation technology. But I think, we have parallels that we've seen in the past, right? Before the internet emerged, copyright law obviously was important. It was something that a number of parties practiced, but it didn't have the same pervasive effect that it has today, where copyright questions really, infect and or inflict a number of online services as they kind of work through their business models and various different interactions with users. In much the same way, if more and more businesses move to these token-based models, and there's good reasons to think that they will, they incentivize a whole host of folks to do things online. They get people excited about projects. They provide a really novel way to build a network effect. And I think we're going to see securities laws kind of play a similar role to what copyright law did in the first wave of the internet. And much like with copyright law in the 90s and into the 2000s, we saw an expansion of secondary liability and new tests and standards that emerged after years of litigation in a number of different contexts. Before we really had stability or somewhat of some degree of stability with the internet and how it interacted with copyright law. I think we're entering a similar phase here with the internet and how it interacts with securities laws as people buy, sell, and trade on highly liquid marketplaces, these scarce digital goods.
Yeah, I think that's a really good way of putting it. If I understood Bill Hinman correctly in your analysis of his remarks, his take on why Bitcoin and Ether aren't securities is that even though people buy them for an investment and hope to make money, but maybe they buy them because they want to do transactions with those tokens, or maybe they buy them as an investment and they want to make money. If they're doing the latter, they're not investing in Bitcoin or Ethereum. They're investing in the commodity itself and hoping that its price goes up. And yet right. These ICOs, you're frequently supporting the new venture.
Yeah, I think it's also a practical concern too. So, right, it's hard to know the intention of why people are buying tokens. In the case of Ether, there's an actual utility. So in order to run any program on the Ethereum world computer or to store information on the Ethereum network, you must spend some amount of Ether. So people oftentimes purchase Ether because they want to run smart contracts. They want to interact with the Ethereum network and leverage it and use it for its unique characteristics. And increasingly, we see more and more people want to do that as this ecosystem of decentralized applications, or dApps, is continuing to mature. But at the same time, some people may be purchasing it because they intend to hold it, anticipating that other people will want to build these applications, and they could enjoy some sort of a price appreciation of some sort. And it's that mixed kind of use transaction, which is tricky to square within existing securities laws. And I think the SEC took a look at it, and they realized that even beyond that, there's another complication, which are these networks are highly fractured and are decentralized. So there's a number of parties involved in supporting the Ethereum ecosystem and the Bitcoin ecosystem. It includes folks that are adding information to a blockchain. Those are often called miners or validators. There's the developers that are oftentimes contributing to these open source software protocols on an ad hoc basis, or as kind of part-time, or sometimes potentially even a full-time job or basis. There's also a whole ecosystem of services that are built on top, like exchanges and wallets and other applications that rely upon both the miners and the software developers in order to do things. This whole kind of mix of different parties that are not centrally coordinated creates a challenge for regulators in determining who should be responsible for fulfilling the disclosure obligations that really underpin U.S. federal securities laws. So the thought is, if there is no party that is entirely responsible for the network and or has some sort of control over the network, then it's hard to put any one of those parties individually in charge of those disclosure obligations. And the thought beyond that is that because the parties are so distributed and because they operate online in a pretty open and transparent way, that there's enough information for folks that are either using the network and are interested in the future growth of the network to make competent decisions. So the thought seems to be that it should, in such instances, relax some of the disclosure obligations. The tricky part, though, here is that a number of projects that have engaged in token sales and have sold them expressly to investors, they may not, number one, be the same as Bitcoin or Ethereum. They may not be these open and decentralized networks, so that by implication means that if they sold them to investors, it's likely that what they're selling is a security. And then that creates a whole host of complications. Financial services companies are really experts in maintaining, managing, custodying, trading securities. So we could be potentially giving a huge windfall to financial services companies where they're going to be effectively the brokers or the broker-dealers of these new digital goods, even though that wasn't the intent. At the same time, there's other networks that may be and intended to be decentralized, but nobody knows the boundaries of what that means. So what does it mean to be a decentralized network? So there's an ongoing conversation both on Twitter and other forums trying to figure out what that means. The SEC and other regulators may keep it purposely vague. They may actually not find many of these networks to be decentralized. So that gives the SEC a bit of power here and the potential to actually become kingmakers or queenmakers or unidentified powerful makers in order to kind of pick and choose which technology we use. And that's something that's a bit concerning for me. We tend not to want regulators to choose winners and losers. So I think it's imperative that we come up with a workable standard for what it means if this decentralized test is going to be adopted. And again, it hasn't been adopted by a court. It's not enshrined in any statute in any sort of way. So it's unclear whether or not this will be the standard. But assuming it is the standard or something that folks find persuasive, what are the boundaries? In my mind, it's similar to what we had to do with vicarious copyright liability. We had to figure out what it meant to actually understand when an online operator would be liable for mass infringement that was allegedly occurring on these networks. And it took a lot of work on the part of courts, and it took careful legislation which got enacted with the DMCA or adopted with the DMCA in order for us to kind of sort through some of those boundaries. So I think that's going to be a big conversation that we're going to face over the next couple of years.
So you think Congress has a role to play here, like it did with the DMCA, in setting the standard that you're referencing?
Yeah, so I think that is an ongoing conversation. There's some draft bills that are popping around Washington that I've seen. Some of the states have actually got involved. So what makes securities laws complex is not just the fact that they apply federally, but they also apply at the state level. So for example, Wyoming just passed a law making it clear that in certain instances, a token that's sold to Wyoming residents would not be deemed a security under its local laws. And in many ways, it kind of mirrored what we saw from the SEC. If it was being sold to consumers or really had a clear use, and it wasn't sold too far in advance and it wasn't sold to investors, then at least according to the Wyoming legislators, that's not going to be deemed a security under their state laws. And we've seen some indication that other states may be interested in adopting comparable legislation.
Right. Tokens don't always have to be mined, correct?
Correct. Right. So for many token sales, they're actually just distributed. There's various different token models that have emerged. Some are provided to folks that validate or provide some sort of security to a transaction. Those are most similar to what we've seen in the Bitcoin and Ethereum networks. Other token models basically reward users for their labor or effort on the part of maintaining either the application or the network that is being built. Those are sometimes called work tokens. We've seen payment tokens, which are really used as kind of a means of payment, kind of like Bitcoin, but may not have the same validation factor. And there's a host of other models that have kind of emerged, which may use tokens in different capacities, including for governance rights or things like voting. So they may not actually be earned. They may be distributed and or disseminated to users of the networks based on their activity.
Right, but if they're not based on activity and they're not mined and they're just distributed, that sort of walks and talks more like a security, right?
Maybe. I think here it's really hard until you really understand the facts and circumstances related to each sale to make such a determination. That's something that's very clear under the law and something that the SEC has repeatedly stated. Securities law analysis is facts and circumstances based. So you really have to look at things pretty carefully and closely. It's a lot like a fair use analysis to bring it back to more traditional internet law or IP related law issues. You're going to have to look at each one kind of on an individualized basis, and that's frustrating for entrepreneurs. It's frustrating for law firms because it's hard for them to issue opinions or get a clear answer. And that's why we're seeing these massive bills that law firms are charging, $200,000 for weak memos that don't really say much. Yeah,
there you go. Stefan, what do you think of all this? Any questions on the securities law front?
I do have a few questions, actually. And something that helps me understand complex technologies is analogies to something that's a little bit more accessible. So I'm going to propose one of two analogies, Aaron, and I'm hoping you can kind of point me to which one you think fits better to help us understand the ecosystem at this point. One of them is, 19th century America, pre-Federal Reserve. You've got a bunch of different currencies floating around that aren't necessarily compatible. And let's say a bank in one city fails, there's a rush on the bank, and inflation kind of pops up and down in an uncontrolled way depending on which bank you're banking with, because everybody has their own currency. Now, is that the right analogy for what's happening now, or is it something different? Is there another way of understanding the currency side of cryptocurrency?
Yeah, so on the currency side, it is unclear. So what we've seen, and that question really deals with Bitcoin as a virtual currency. So what we've seen over the past nearly a decade is that we have a decentralized network in the Bitcoin network that's relying on a blockchain to keep track of who owns what Bitcoin at what point in time. That network has grown quite large. It processes a number of transactions. It has a number of services that are built on top of it. And folks increasingly are using that to store value. So they're saying, hey, this thing is not tied to any government. It's nearly impossible to shut down. It looks a lot like BitTorrent or other peer-to-peer networks, which have these emerging properties, which make them difficult to shut down. So we think that over time, this is going to become more and more reliable and will almost serve as a check in traditional fiat currencies. And we're seeing some evidence of that in places like Venezuela or other places that do not have stable currencies. Folks are opting to store their value in Bitcoin instead. So it almost is like a hedge on the entire global economy. And it's also pretty non-correlated, which makes it attractive for folks that are interested in diversifying the assets that they hold. And that's super exciting and very interesting. and really feeds into a whole conversation about digital currencies and e-currencies and virtual currencies that's really been in existence since the 90s. And what we've seen, based on research that happened in the 90s and more research that's happened today, that if this Bitcoin or some other blockchain-based virtual currency becomes so large and pervasive that it begins to threaten, in some capacity, traditional currencies in either a jurisdiction or in the US or the euro, et cetera, that I'd imagine that the states at that point in time would react by basically rolling out digital currencies, fiat digital currencies that have all the same characteristics as virtual currencies, but are easier to use, can be broken down into fractions of a penny, and really mirror the real-time world of the internet. And to, again, draw a copyright analogy, we saw Napster emerge, which really began to place a pressure on traditional media companies, particularly music companies. And we saw that because they didn't react fast enough, they began to lose market share. They began to lose their ability to control the distribution of these goods. But today, people don't use Napster, right? They're now gaining access to music through large cloud computing or cloud-based services like Spotify or other online services that pretty much have all the same characteristics as Napster, but are centrally controlled, are carefully curated, and abide by the law. And that's what researchers have kind of looked at with Bitcoin and other virtual currencies. The token sales are different. I think one way to think about this is imagine if today Facebook started, and instead of having an unlimited number of user accounts, it only had 300 million user accounts. So you pretty much needed to own a token in order to access Facebook. Well, I imagine if 300 million people were on Facebook, and I remember when 300 million people were on Facebook, it was pretty great, right? There wasn't as much spam. There was no concern about fake news. You could connect with your friends, et cetera. And if you were an early adopter of Facebook, maybe you would have earned a whole host of these tokens based on your user activity, based on your ability to talk about the project or engage in some other useful activity for purposes of the network. Well, if that network grew in size and more people wanted to use it, then there would be an appreciation in the value of that token such that other people may want to buy it. So maybe when it launched, you purchased a Facebook token for a fraction of a penny, but 10 years later, the market price for having a Facebook account was $5, $10. Well, that would be pretty interesting and pretty useful and actually kind of solve some of the commons problems that are inherent in many of these online networks that we've seen emerge over the first wave of the web.
Wow,
so it's really thinking about that.
Two great analogies, the Napster one and the what if Facebook had operated differently at the get-go one. I think that really helps people understand both situations. On the cryptocurrency front, you've sort of set the stage for two possible realities, I think. One is the Napster to the music industry one. If you can't beat them, join them, figure out a way to provide similar functionality in a way that you can live with. And I guess the person that statement's being directed to or the entity are governments, right? So right. If you can't beat them, join them, and you better join them is one reality. The other one, I guess, would be there are various governments that are still in the early RIAA days where they're thinking they can squash this problem and regulate it out of existence. How's that going?
Yeah, I mean, I think that there's some jurisdictions that are taking a harder line stance when it comes to virtual currencies or cryptocurrencies, most notably China. And I think that is largely in line with their internet policy that we've seen up to date. So China erected the Great Firewall, which precluded a number of online services from doing business in China. And what that permitted China to do was pretty much build a large ecosystem of local native internet companies, right? So because it was so difficult for, let's say, Google to operate in China due to its rules related to the Great Firewall and its rules related to state censorship, it was able to build Chinese-based search engines that have grown quite large in size, right? Because it was difficult for Amazon to do business in China. We've seen Alibaba and other online services emerge there. So I wouldn't be surprised if that's what regulators in China are thinking about. They see that there's great potential for the technology, but they want to make sure that they understand it, they can control it, and they can build and cultivate a number of companies that can leverage the technology. Europe took the opposite approach, right? They permitted American companies to do business in Europe, and we haven't seen the same level of innovation from EU tech companies. So there's a good argument that China made the right decision, even though I disagree with the idea of censorship. But from a economic perspective, I think it benefited them. So I think we're gonna see similar challenges and questions kind of emerge. We may actually even see some state-sponsored blockchains from areas like China or other parts of the globe.
Yeah, let's get back to Wyoming for a second. Do you think that what they've done will be a model for either other states or the federal government?
I hope so. I drafted part of it, so
you did.
I think it's pretty. It's a pretty good law. I think it's the step in the right direction. I imagine that we'll see other states that are interested in it. Whether or not they adopt it in whole cloth, time will tell. We've seen similar efforts from states to begin to accommodate smart contracts or the ability to memorialize parts of agreements in software under state laws as well, and those have begun to kind of expand. Arizona, Nevada, and a host of other states have passed smart contract legislation. So maybe we'll see something comparable on the token front.
Really cool. Any last questions on either of these fronts, Stefan?
Yeah, going back to the Venezuela point you made, I just want to push on that a little bit, because it sounds like what you're proposing is that there are individuals using this technology to kind of get around unreliable currencies in parts of the world where governments can't back the stability of their monetary policy. So, how is this technology different from avenues that were available to wealthy people in places like Venezuela before, where they could, for example, put their money into fine art that would then have value outside of whatever country they're in. In fact, I've heard fine art described as bitcoins for billionaires, or if not fine art, then foreign currencies or other sort of financial products that could get someone who has a lot of assets more security than what they could have if they were buying currency in their own country's currency. So how is this different?
Yeah, it's a great question. Well, number one, not everybody's a billionaire, and we don't yet have fractional ownership of other stores of value like artwork. Blockchain technology may actually help spur such efforts. And I think the real difference is it's just so easy to use the technology, right? We've effectively turned assets into email. We have the ability now to zip an asset like Bitcoin, like Ether, or some of these tokens across the globe in a matter of seconds, no matter how large or how small that asset is, with some minor limitations for those that are more technical. It's effectively costless or very, very low cost. And it's available anywhere there's an internet connection. There's even been examples of folks transmitting Bitcoin over the radio. There's satellites that are being strung up so that you can interact with them, so they're not even dependent on traditional ISPs or other internet service providers. So it's a highly resilient. It's tamper resistant, which some people will call censor resistant, or you don't have the ability to really halt the ability of folks to purchase it. And beyond that, it's universally available. So that means if I'm someone in Venezuela and I only have $100 or even less than that, because I may not have that much in terms of means, well, I can walk down potentially to an internet cafe, log on to an online service, buy some Bitcoin, keep it in my account. And if I decide to go to another country, then I can do that as well. We also have seen, particularly when there's political unrest, particularly around World War II, the confiscation of other stores of value, things like artwork, things like jewelry, things like diamonds, or other things that people have used to kind of custody and maintain wealth. But it's pretty hard, to actually extract from somebody their Bitcoin private key in order to transfer those assets. So I think in times when there's political unrest, in times when there's political uncertainty, in times when there's economic uncertainty, that there may actually be a legitimate and highly valuable use case for things like Bitcoin or another virtual currency.
So I guess I would be remiss if we left this topic. We discussed one aspect of the legal opportunities related to ICOs, advising startups in how to execute one of these so that you don't get sued. The other side of that, I guess, would be the shareholders' lawyers who are waiting in the wings for the SEC to either do a sweep or a selective handful of enforcement actions. You've called this chum in the water when it happens, Aaron. But as soon as the SEC gives an indication that here's what we think violates the law, the sharks will come swimming in.
Yeah, and there's definitely indication that plaintiffs' attorneys think that a number of these sales violated federal securities laws. There's a number of lawsuits that have been filed, particularly against prominent token sales, sales that raise upwards of $200+ million. The most notable one is a handful of actions that have been filed mostly in California related to a project called Tezos. We've also seen that securities lawyers kind of piggyback on some regulatory activity that the SEC has gone after. There's a project called Centra that plaintiffs' attorneys began to raise question with, and then it led to some SEC enforcement, and then that led to even more plaintiff side lawsuits. But I think, once we have a clear indication from either the SEC or court as to what some of the boundaries are between tokens that are securities and are not securities, and if there's a downward pressure on price and investors or purchasers of those tokens feel like they lost a significant amount of value, I think that plaintiffs' attorneys will begin to kind of sweep up the mess. And that's kind of how the federal securities bar works. Or the securities bar across the country. The SEC gives kind of an indication, and then the securities lawyers kind of keep everybody else in check.
Right, and the other thing I guess we should mention before we move on is the wildly, back to the currency markets and use of tokens as cryptocurrencies, is the fact that we've seen this precipitous drop from last year's big peak in prices for things like Ether and Bitcoin, and that you think that could actually be a good thing and put us more on the course of aiming toward those legitimate, useful applications of blockchain and these tokens.
Yeah, I think many folks, particularly the legitimate folks within the industry, they're looking at this from a 10 to 20 year arc. They really think that this is, the next wave of the internet. It's not going to materialize overnight. And if exuberance and or expectations of the technology outpace what is possible to have delivered today, then that's not healthy for anyone. So yes, we've seen a decrease in the price of some of these assets. But that being said, they're much higher than where they were a year and a half ago. And there's been a tremendous amount of value that's been poured into and or accreted to these marketplaces. So as of today, there's something like $200 to $300 billion worth of these assets that are sold. 2 years ago, it was something like $10 billion. So there's been an incredible interest and expectation of what blockchain technology can do. But it also provides a fertile basis to really experiment with building out a new commercial stack. There's $200 billion in assets. There's reportedly, I think, because of Bitcoin and the Ethereum price increase, something like 20,000 new millionaires that have been minted across the globe that are interested in investing more time, effort, and resources into building out this ecosystem. And that's incredible. And I think that's what we're going to see here. We're going to see entrepreneurs kind of use that $200 billion base, with the expectation that base will grow over time. We'll see more and more assets that are being managed and recorded and maintained via blockchain. So everything, beyond virtual currencies and these tokens, but to things like real property, intellectual property, securities, overt securities, machines, a whole host of these assets will be managed via blockchain. And then we'll see new layers emerge that really can start doing some magical things. Because just like we had with communications, we turned letters basically into email. We were able to send communications across the globe nearly instantaneously. That led to a host of changes, structural changes to the media industry, opened up opportunities for e-commerce, and a whole host of really interesting new business models during the first wave. If we do that to something that's arguably more valuable than communications, hard assets, and turn them into something that you can transfer across the globe nearly instantaneously, break down into very, very small pieces, much smaller than what we're used to today. There's going to be a host of new businesses and services and opportunities that emerge over the next 2 decades.
Did you say 20 million new millionaires?
No, 20,000, I think. If
20,
I said 20 million. Yeah.
All right.
But someone said it's one of the largest wealth transfers that we've seen. So that's from Twitter, but to the extent that that's true, it's an interesting point.
Right.
That there's been so much wealth that's been transferred to a whole host of people, and we saw temporarily that one of the founders or co-founders or one of the major backers of Ripple was arguably the third or fourth richest person at some point a couple months ago. So tremendous amounts of wealth are being created and transferred around via these networks.
Right. All right. That's going to be our first MCLE passphrase for this episode of This Week in Law, 20,000 millionaires. We put these phrases in the show in case you are a lawyer or another professional, and in your field, getting continuing education is a thing you have to do. So some people love to watch and listen to our show for that purpose. If you are a lawyer, we've got some resources for you over on our wiki. If you go to wiki.twit.tv, find our This Week in Law page there. And you'll get some guidance as to whether you can apply in your jurisdiction and how you might go about doing that. We'll put another phrase in the show later on so that if you have to, you can demonstrate that you actually watched or listened to the show. I actually heard, Aaron, since you're teaching law in various venues, I heard from a law professor last week who is assigning the show as part of their coursework, and they want to use our pasphrases to verify that the students watch or listen to the show. So I guess they could have multiple purposes. In any event, we will put another one in later on. And right now we're going to look at some practical applications of what we've been talking about. We've hinted around about smart contracts, et cetera. Let's talk about the blockchain of things, shall we? Oh my gosh, I mentioned at the top of the show that Aaron has co-authored a wonderful book called Blockchain and the Law, The Rule of Code. I can call it wonderful even though I haven't read it yet. I am about to read it because what I did read was this piece that we have in our rundown called The Blockchain of Things that was published in Slate's Future Tense column. And it is about the smart contracts that our devices are beginning to have with one another, and the future where they have lots of them all the time. So let's talk about the thing at the top of your piece here. This is you said, a lightly edited chapter from your book?
Yes.
Yes. So what the first example you give is of an open source software company in Russia called Drone Employee, that was flying a drone without any human intervention whatsoever. The drone's software and mechanisms were all triggered via a smart contract running on Ethereum. Tell us more about that.
Yeah, sure. So, one potential long-term, and this is not necessarily possible today, but something that a number of projects and folks are working on, is using a blockchain as kind of a persistent data layer to manage communications and or asset transfers between devices and machines. So there's a big trend that many folks are working on to connect more and more devices to the internet. That's called the Internet of Things. It's estimated that something on the order of 50 billion devices will be connected to the internet over the upcoming years. And the thought is if you have all these devices that are connected to the internet, number one, how do you ensure that that's secure? How do you prevent cyber attacks or cybersecurity attacks from infiltrating those machines and preventing them from operating in an effective way? And the second possibility that folks have been thinking about is how can these machines engage in commerce with one another? And the thought is that, if you have one machine that is a bit larger, has a more powerful computer, and it can interact with other machines, well, maybe it can sell its resources to that machine. So we've seen some initiatives from folks like IBM and Samsung where they've really modeled out in their R&D labs this future where machines are engaging in commerce with other machines. And the other possibility, which we've seen a lot of folks playing around with, is actually controlling these machines with smart contracts. So smart contracts are, again, these little computer processes that run on blockchains. The most notable blockchain that uses them today is the Ethereum blockchain. And these smart contracts have a unique attribute. They're stored currently directly in the blockchain, which means that the computer program can't be deleted. And it's run by all the different computers that are supporting the blockchain, usually in parallel. And what that means is that no single party on the network can halt the smart contract from operating or can preclude anybody from using it. So folks find this interesting, and it could potentially be used for useful purposes, right? To know with certainty that a device is going to get to a location at a specified time. But your mind doesn't need to wander far to think about how this can be used for nefarious purposes. If you have effectively autonomous software that can be stored on a blockchain, can't be removed, and it can be tied and or control a device, then it can be used to power a whole new generation of weapons or other concerning devices. So it's a really, really interesting pocket of blockchain technology. One that's we're gonna I think see emerge not in the near term, but over the next decade plus, raising a whole host of new challenges. But I think the really interesting thing is this machine-to-machine commerce. So maybe I can paint like a picture of what that could look like. So the thought's something like this, right? Imagine your whole house has devices connected to one another, and you have internet-connected windows, and you have an internet-connected sprinkler system, and you have an internet-connected refrigerator. Well, maybe the sprinkler system can't have certain sensors attached to it because it's too expensive to embed them in the sprinkler system. Maybe it operates underground, so it doesn't have as much internet connectivity. Well, Windows are able to store potentially more computing processing power and could take temperature readings, humidity readings, and then sell that to the sprinkler system, who would pay a small fee denominated in a cryptocurrency. And that would enable the sprinkler system to automatically turn on or do whatever the owner of the house would do. But maybe the window can't power other sorts of activities that would require more computational power, maybe like processing the humidity information or the weather information. So it would pay a small fee to a computer sitting in the refrigerator, which obviously could fit a much larger, more expensive computer within it because nobody would really care or even know that that exists. But this entire ecosystem would be managed via some sort of virtual currency of some sort, a blockchain kind of storing all the interactions between one another, and that could be the ecosystem and world that we see emerging in the future. So I guess the headline is, get ready for machines contracting with other machines. It's coming.
Yeah, definitely. And I assume it could be structured in a less draconianly capitalist way where, maybe I don't want my windows charging my sprinklers anything. Maybe we all live in the same family and can share this information. I suppose you could structure the token that's necessary to execute the transaction such that it doesn't actually have a monetary value. But Yeah, it's a fascinating concept. The drone part of your discussion made me think immediately of this company that I stumbled on this week just in wandering around the web. It is called flythere.com. It is basically drone tourism, where right now you can use their service. You pay like $10 a pop, I think. And right now they're operating drones in Mexico and Thailand. And if you just need, to get a vibe of a nice Thai beach or something down near Cancun in Mexico, you can you're remotely operating the drone, but you could definitely see how, based on this Russian company and what it is doing, how something like this would not need any human intervention, that it could just, if you wanted to provide a service to say, here, you don't have to fly this drone. We're going to operate it all via smart contract for you and show you the best of the area. Right. You can do it that way too. And I tweeted that out, and someone came along and said, how long until all the self-driving cars start doing this? And that's the next point in your article as well, in your chapter, that, again, smart vehicles are capable of doing these kinds of transactions with each other. The legal overlay of all of this is really fascinating. And your upshot here is that we're going to have to think about contract law in this context, because when we're talking about non-autonomous machines, the law as we have it now kind of holds up. That you could have enforceable contracts between your windows and your sprinklers, because really they're acting on your behalf. But what happens when these things start thinking for themselves? How are we going to handle that, Aaron?
Yeah, I mean, I think that's an interesting question, right? And one that we're going to need to grapple with. So that's an eventuality. I don't know if that's coming anytime soon, but at some point, machines with sufficient artificial intelligence or some other software could conceivably be able to take actions that the creator of that artificial intelligence or the creator of that machine cannot anticipate. So it becomes difficult at that point in time to hold that person to any activity that may flow from that, unless it's expressly authorized to do so. I think we're going to need to think about that, and I think it's going to depend on the amount of value that probably is going to flow between these machines for us to figure that out. So one thing we could do is potentially try to exert some sort of control, or say, if you're going to manufacture one of these devices, then we need to have the ability to hook into it if there's some sort of problem or dispute, or ability to collect funds if somebody's damaged in some capacity. But I do think that these types of questions are coming. Probably not, again, in the next 5 years, but over the longer term. And it's conceivable that blockchains really could be a useful way to manage some of this activity. In part why like IBM and Samsung and all these other folks are looking at blockchains for IoT is, one is they think it's a solvable problem, some of the scalability concerns about blockchains. And B, they're neutral. They're not really owned or controlled by any one party. So they operate a lot like an operating system, something like Unix or Linux. And we've seen that when you kind of create this neutral software layer, it enables a whole host of different companies to work together and interoperate and build entire ecosystems. And that may not be possible if only one company is really managing this entire process. If we're envisioning a world with a whole host of devices and a whole host of different businesses that are manufacturing them, we're not going to want that all to wrap through something like an IBM or Google. We're going to want to build this neutral layer to do that.
Yeah, and I think we're going to have to think about, is contract law really even the rubric for these transactions? I mean, I can certainly envision, as you said, it depends on what the subject matter of the transaction is and who the ultimate parties are. I don't necessarily need contract law to mediate whether my window provided an accurate reading to my sprinklers, who now say they've suffered damage because the lawn is dying. If you tried to involve a court in that dispute, you would definitely explode some judge's head. But right. at some point, the transactions between devices are going to be important, and accountability and damages are going to be a real thing. So maybe we do need some form of contract policy to mediate those transactions.
Right. Yeah, let's say, I mean, not to push too far in the future, but let's say it's a robot, right? Like a fully autonomous robot that's adding a lot of value, that's providing labor. I mean, we see today with, employees or workers that are providing services, there's plenty of disputes that emerge, damages that can occur. So it's conceivable that if you have something like a, fully autonomous, in the true sense, autonomous robot, that's engaging in the world and adding value, but also potentially could create some risks or damages that we're going to have courts or other folks deal with that. And I think Ryan Calo has talked quite a bit about and written quite a bit about some of the liability and other issues that emerge with robots. But I think here it's kind of interlaces with some of that thought and that jurisprudence.
Right. He's been on our show several times, and he does a great conference every year called We Robot, where they grapple with these kinds of issues.
These questions.
Yes. Yeah. Stefan, what do you think about all this?
So I agree that contract law might not be necessary or sufficient here, because ultimately, if you're having a dispute between your sprinkler and your fridge, there's a question of ownership that has to come up too, right? I mean, when you contract, that's like an overlay over an underlying property question typically. And so one of the central premises of all this is that it's distributed and not centrally owned. And so I think that's where the tension really arises, is who do you go to if you have a problem? Accountability and ownership are so closely linked that it's difficult for me to disentangle them. And this is going to sound absurd, but I've been reading this book on the history of the early Bolshevik elite, and one of their main preoccupations was that Bolshevism was going to be spontaneous and collective, and the spontaneity aspect of it was very important to their ideology. It was this idea that it was all going to come up in this decentralized way, because as soon as everybody understood what was at stake, they would passionately pursue these goals, passionately and collectively and spontaneously. And the rhetoric around blockchain is quite similar in terms of its resonances, which is that it's going to be this decentralized thing that everybody's going to band around and build a system through. And I guess, as the Bolsheviks discovered, the ownership question is a very difficult one to solve. And I think that there's a similar problem at the heart of this question for me, which is, if you can't pin accountability on a single owner, it can be very hard to resolve disputes. And for me, that's a harder problem than the contract problem, actually.
Yeah, I think you're raising, blockchain governance questions, which are similar to internet governance questions. And we've seen a whole host of, organizations that kind of manage or have accountability for certain aspects of the internet, both formally and kind of informally. But that's a very, very big, very complex topic in the blockchain community. Assuming that these networks become larger, assuming that they're managing trillions of dollars in assets, and assuming that more and more devices potentially are relying upon them. Who has control over them? How should they be updated? What happens if there's problems? What types of liability should attach? And I don't think there's a clear answer yet as to what that governance is going to look like. So I imagine we'll start seeing much more innovation and much more thought around that as these networks become more powerful and more pervasive.
Lest people think that we are merely speculating about angels dancing on heads of pins here when we're thinking about autonomous devices on a blockchain carrying out things that are dictated by the smart contract that's governing their behavior. Tell us about plantoids, which are also mentioned in your book/article. What are they, and what are they doing?
Sure. So that's actually the work of my co-author of the book, Primavera de Filippi. So it's an art project, and what it does is it's a piece of artwork, a little plant that's connected to the internet and relies on some smart contracts and other blockchain technology. And you basically can pay it, Bitcoin or Ether, and it will do a little dance for you. It will do other things that are kind of pleasurable, like blow bubbles or smoke, or depending on kind of how it's set up. But beyond that, it can also send out a request to be reproduced, and other folks can bid on, and other devices can bid on that and make proposals, which other folks that have created plantoids can vote on, and it can effectively try to reproduce itself. So it's just kind of a fun way to bring some of these concepts into a different context, to think about some of the emergent properties that can happen when you move to these blockchain-based networks. But even beyond that, talking about real-world applications, there's a company based in Denver called Filament. They've already begun to build out a core piece of this internet IoT or blockchain of things technology. So they have devices that are secure, that they call droplets or taps, and they permit different machines that have these devices embedded, or if they're a separate device, to engage in kind of commerce with one another. So there's this technology is, it's still early days, but you're starting to see the threads of it emerge, both from large industrial companies like IBM and Samsung, but also a whole host of other startups that are beginning to tackle some of the problems related to it. All
right. So your article goes on to speculate that the the plantoids and various other things that are governed by terms living in a smart contract on the Ethereum or another blockchain, without any centralized control and with growing autonomy, could start to do things that people did not predict and might be a little bit more harmful than dancing. So teeing that up, I think brings us to our next subject matter about smart contracts that both involve devices and maybe involve people too. So I mentioned at the top of the show, Aaron, that you're the developer of OpenLaw, which is a platform. Well, why don't you describe what OpenLaw is?
Yeah, sure. So, OpenLaw is a project that was started about a year and a half ago that really is building out the legal layer that's going to sit on top of the Ethereum blockchain and potentially other blockchains as well. So just to kind of do some level setting. So smart contracts, again, they're small little computer programs or computer processes that operate on a blockchain. What they really excel at today is moving around assets that are either native to a blockchain, things like virtual currencies or representations of assets, i.e. tokens that exist on a blockchain. And we've seen, again, hundreds of billions of dollars, up to $1 trillion of these assets being created. And the hypothesis is that over time, the next 5, 10, 15, 20 years, we're going to see more and more of these assets being managed via blockchain, trillions of dollars worth of it. And because you can use these smart contracts to move around these assets, a whole host of new commercial activity can emerge. And we want to figure out a way to kind of marry that with traditional contract law, also marry it with traditional businesses. So you can't represent every single contractual promise as code. You can only represent a handful of performance obligations in a contract as code. And we have other provisions in contracts, things like representations and warranties, dispute resolution provisions, other promises that you really can't reduce down into software. But we're going to want to marry the two together, and OpenLaw really does that. So we basically use a blockchain to manage the creation, execution of legal agreements. So we built in a whole bunch of document automation tools, and we manage the entire lifecycle of a contract via blockchain. We do that without passing through any intermediary. So there's no DocuSign, there's no Rocket Lawyer, there's no LegalZoom, there's no law firm that needs to actually be introduced into the system. And folks can basically engage in the digital context for the first time in an entirely peer-to-peer manner. So much like what we had with paper, where me and you, Denise, could enter into a contract, we could write down on a piece of paper, and no intermediary would necessarily need to be involved. We can now do that in the digital realm as well, using a platform like OpenLaw. And because we can effectively trigger smart contracts once the contract is signed, we can do some really, really fun things. So let me give you a couple examples because it may be interesting. So we modeled out an employment contract. So it looks like a standard employment contract that many folks have probably entered into. It articulates the name of the employee, his or her, their position, what they're going to be paid, has various different promises, like they're not going to bring in IP from another company. They're going to agree to some dispute resolution, which is increasingly common. But we modeled out the payment obligation, i.e. what the employer is going to pay the employee, using a small 20-line bit of smart contract code. And what we demonstrated is when you turn assets into something that's equivalent to email, you can actually start paying people in real time. So imagine a world where in 20 years, everybody's not getting paid every 2 weeks, but because it's so easy to move around assets, people get paid every minute. And not just that, we modeled out how you could actually pay taxes in real time as well. So the government could collect taxes as you're getting paid every minute, because it's pretty easy to reduce down things like the tax code, which is objectively verifiable, into smart contract code. And what that would mean is much less tax compliance on the part of companies, much less need for auditing and oversight, because you would have these smart contracts which could potentially be validated and verified by the government, basically handling all of the obligations of collecting taxes. We also put together an example with a large law firm down in Australia called Coors, where we showed how parties could represent a title to real property, a piece of land on a blockchain as a token. And we used a standard residential sale agreement down in Australia, which had all the relevant information about the buyer, the seller, the lender. But we wrote a couple smart contracts that enabled the buyer to put down a deposit that was stored in a virtual escrow account. So not an escrow account that's maintained by an intermediary, but one that's maintained by a smart contract. Have the lender provide the loan. Once that's cryptographically proven that the buyer put down the deposit, that the agreement was signed, and that the lender paid the appropriate amount or lended the appropriate amount, it was automatically sent to the selling party, and the registry was updated. So that seems pretty simple, but today that takes about a month for most governments to accomplish. And we showed how you could basically do that in about a minute or two if all the information is there and the parties were synchronized. So we're moving from an era where assets are kind of hard to move and slow to an era where assets are going to be moved around in a much more efficient way. And right. OpenLaw is really a platform that enables us to kind of marry the best things about the existing legal system, contracts that manage risk, with all of this really, really efficient asset transfer that's emerging, and that I think we're going to see over the next period of time. And beyond that, we've kind of just built a lot of the existing legal technology and wrapped it into one coherent system, so that folks can begin to basically have widespread legal automation available effectively for free. And we're building a GitHub-like system that will have tens of thousands of agreements that are blockchain compatible, that will be available, that folks can collaborate on and interact with, and kind of fork and move into their own ecosystem. So there's a huge effort in the blockchain community to basically build this legal layer, and I think we're going to start seeing a lot of legal tech innovation emerge in blockchain over the next five plus years. And I think it makes a lot of sense. It's not just bankers that built Wall Street, it's bankers and lawyers, right? It's not just creative workers that built Hollywood, it's creative workers working closely with lawyers, agents, and other legal professionals to basically build Hollywood, the music industry. Same thing with insurance, right? It's not just folks managing risk, it's also the lawyers that are architecting it. So it's really that symbiotic relationship between lawyers and their clients that enable massive amounts of commerce. And I think blockchain developers understand that. And they've effectively built the bank or the asset layer. And now they need to build that legal layer to bring it kind of to the next step. So
one of the things,
cool.
Yeah, it's really, really cool. It's really mind-blowing, everything you just told us. And one of the things I'm thrilled that you're working on, based on everything you just told us and based on the specter of the plantoid gone wild a la Little Shop of Horrors saying, feed me, is you're working on some friction in the execution of these micro transactions or macro transactions that take place via smart contract on the blockchain. And you're working on a stop contract tool that I assume, one of the things that people like about our system as it exists right now is if there is some sort of hesitation about whether you owe that tax or whether that employee has earned that minute by minute compensation, it's because there's so much friction in the system as it exists right now, the brakes can readily be put on and that question can be resolved and everyone can move on. So is that what stop contract is going to do as well?
Yeah. So, today, if you enter into a contract, both parties have the opportunity to breach, right? And a court ultimately will decide whether or not that was a breach legally and then award damages. With smart contracts, because they rely on, the Ethereum network or some other network where the code does not necessarily need to stop, or a payment or other asset transfer does not necessarily or can't necessarily be halted, it kind of flips the default rules. So if you agree to something and there's a smart contract embedded in the arrangement, that asset transfer is going to occur if certain conditions are met, even if you wanted to back out of the agreement. And that can work in a number of instances. So, for example, financial services companies, they're really interested in this technology because sometimes they know that folks will breach a contract even though that wasn't the intent of the party, just to kind of create chaos or try to rework a deal after the fact. And that may benefit the party trying to rework the deal, but may not actually accurately represent the intent of the parties. So we built a whole host of tools to basically provide a degree of control over autonomy. So maybe in certain instances, you want that autonomy. You want to know that if you enter into an agreement, an asset transfer is going to be managed via blockchain. That's going to occur regardless of the intent of the parties or some sort of outside condition. But in many instances, parties are probably going to want a degree of control over those asset transfers. So we now are bringing in that control back into a blockchain-based ecosystem. So it effectively, right now, you can do a unilateral termination of an agreement, but we will be modeling out how you can do a bilateral termination of agreement, and/or really what I think we're going to also start seeing, which is basically enabling both parties to, or one or more parties to basically halt the agreement and then trigger some sort of ADR-like dispute resolution proceeding that will happen and be facilitated via these smart contract programs. So,
wow. Have you read Cory Doctorow's book, Eastern Standard Tribe?
I have not. I probably should.
Put it on your reading list, because there's a great little passage there where somebody gets into a fender bender with their car and their smartphones broker the insurance settlement of the dispute right away. And I think they go on to date, if I'm remembering properly, the people who were involved in the accident. But this is beyond that. It's happening not just, there doesn't need to be I think it's like a chatbot interface in the story where this is all being brokered out. You're talking about things even more instantaneous than that. And it's kind of blowing my mind. How about you, Stefan?
Yeah.
The interesting thing about this is what it sounds to me like is it's a great way to reduce transaction costs between contracting parties who are both sophisticated. And if everybody understands the consequences of a breach and how that impacts their own performance, for example, they can agree to these terms and automate the actual execution and reduce the transaction costs without much in the way of downside. What I'm wondering about is, are there plans to try to make asymmetrical contracting more equitable? Think about 2008. One of the reasons we had this huge financial meltdown is there were a bunch of contracts being entered into asymmetrically between sophisticated and unsophisticated parties that created a lot of debt obligations on the part of the unsophisticated parties. And when those contracts were enforced, we had this massive foreclosure crisis. And it sounds like the smart contract system you're proposing could actually accelerate the pace at which we have this disastrous consequences if you don't account for the asymmetries that are inherent in contracting across sophistication gaps. And so what could happen then is we could have financial crises at record rates. And so what are some of the ways in which smart contracting technology could help alleviate some of the social costs of asymmetrical contracting, as we saw 10 years ago, for example?
Yeah, I think that's a great question. So this is not necessarily blockchain technology, but what we've built in the OpenLaw platform is a domain-specific markup language. We basically enable anybody to upload an agreement, to mark it up, and structure it in some sort of way. So we will know now, if we use these types of systems, relevant information about the agreement, the parties, optional terms, the term of the agreement, and other information that's highly relevant to enable parties to kind of assess a commercial transaction. And once it's structured in this sort of way, we actually could start building analytics tools and or other services that enable folks to have a more holistic picture about what's going on within an agreement. And that's the really interesting part, and one that I think will be incredibly valuable to narrow some of those informational asymmetries. Today, agreements are wonderful, but they have limitations in the sense that the parties that enter into them, they kind of sign them and forget them. They don't know actually what's in the agreements because it's not structured. We've seen efforts in the legal tech community to apply things like artificial intelligence to those agreements in order to structure them, but those efforts are limited because as I think any lawyer who's listening would know, contracts are very context specific. They often use very arcane language, and frankly, there's not that many of them, at least as compared to things like images or videos or other things where we've seen AI techniques work really well. So our approach is basically to enable lawyers to work together and to begin to structure these agreements, develop templates that then can be used and modified and customized by an individual lawyer in order to really make it easier for us to understand what's going on under the hood effectively. And hopefully by doing that, we'll be able to narrow those information asymmetries. We'll be able to learn more about common provisions and what folks are doing. And at the same time, we'll be able to keep better track of them. So imagine if you enter into an agreement in the future using something like OpenLaw, and you get an email 30 days before the contract will terminate. Well, that would be hugely beneficial for consumers, right? And that just happens automatically. That just kind of built into the system or baked into the system. We can't do that today, right? The reason we can't do that today is because we have no clue what's in these agreements, either once we sign them or as they're being created. The lawyers obviously do, and sometimes the clients, but we just forget about them. And here we can actually start building real-time workflows and much more useful systems that can hopefully help people and hopefully engage in commerce with the right amount of friction, right? With the amount of friction that parties want. So it's still early days, right? We're still in the kitty hawk phase of smart contracting technology, but things are moving pretty quickly, and it's definitely a very, very interesting area. And the headline, I think, for lawyers or other folks that are listening, is that these blockchain-based ecosystems are interested in legal technology for the first time. And they have lots of assets that they want to move around and are willing to experiment with in terms of structuring new commercial transactions. So it's going to be an area that's going to be interesting to follow and watch. And I think we're going to see some new things emerge from it over the upcoming years.
It seems as though, too, there could be some sort of rating system incorporated into the markup of not into the markup, but into the information that you get by having a marked up contract, where you basically take the legal analysis part of it out of it for the layperson who can't understand all of the legalese, and all they would need to know is this has been reviewed and vetted as something that is not taking advantage of you, and you should feel good about that and adopt this contract. There's something in our materials for today called the Agreements Network. Sure. It's set to launch in October, and it's working to offer a low or no code solution to creating and executing smart contracts. Is that something you're working on as well, or is that sort of a side, parallel project?
Yeah, so it's more of a parallel project. So again, OpenLaw is one project that's trying to build out this legal layer. There's a couple other projects that are trying to do the same thing. But the thought is, how do we get a whole network of technological layer that enables a whole network of law firms and other legal service providers or other folks that need legal to kind of work together. Blockchains are kind of a neutral data storage layer. They're really good at keeping track of information. And that includes information related to agreements. So, did the parties sign the agreement at this point in time? That can be cryptographically proven and timestamped so that narrows opportunities for disputes related to who entered into a contract. And with additional technology that we built and other folks I think are trying to build, you can actually reopen the agreement, right? So imagine if you needed to amend an agreement, you don't have to start from scratch or kind of dig it up. You can just reopen it, make a couple changes to the structured data, and then re-execute it, send it out for signature, have it all digitally signed. And I think what's also interesting, and we're doing this at OpenLaw and other folks are doing it in other contexts, once you apply modern software techniques to it, you can begin to surface this information in a whole host of different user experiences to address some of the issues like you mentioned before, Denise. Maybe you have a standard agreement like a terms of service, but the key provisions are rated, and or they're surfaced in a way that's easy for everyday consumers to understand. So even though the legalese kind of sit in the back end and can be standardized or interpreted by folks that have the sophistication and or the knowledge to do so, it can be provided to consumers and users in a much more user-friendly way. Right. And you can also play around with even new ways to enter into agreements. So we've seen innovations like folks interacting with chatbots. That hasn't fully taken off yet, but is really interesting. But once you have structured data and you actually know what these agreements, what the parts are, you can actually feed them into systems like Amazon Alexa. So imagine entering into contracts by talking to an Alexa. Walk into a lawyer's office, understand the lawyer understands your problem and turns you over to some sort of electronic system where you just provide your information and contracts are sent out. Or imagine setting up a company, and when you file the relevant information about your company, you get a whole vetted set of legal documents that get spit back out to you after you pick from the menu of options. We can really reduce the cost of legal and actually help people do what they want to do and increase the quality at the same time. I think that's a really important and feature that's rapidly coming into existence.
Yeah, it's gotta, some of the tech pieces have to improve along the way. I'm not ready to contract via yet. Not just yet. Let's talk about some interesting things that people are doing with the technologies that we've been discussing today. We've mentioned DApps, distributed apps. That's what apps that run on the blockchain. Primarily, they have run on the Ethereum blockchain until now. Now we've got the Lightning Network on Bitcoin, so L apps in that platform, which are apparently solving some of the DApp problems. The most famous DApp was CryptoKitties, correct?
Yeah, so that was one notable application that was built on top of Ethereum. DApps, or decentralized applications, rely on smart contracts for one or more of the functionality related to them. So there's fully decentralized applications that rely on a host of smart contracts. There's semi-centralized services that just use smart contract components for it. And we're also seeing emerging, particularly from the Ethereum ecosystem, all these token standards. What's particularly interesting about CryptoKitties is that they've created non-fungible tokens, or effectively scarce digital goods that can be used and are cryptographically tied to things like artwork. So you can transfer around the token, and that can prove that you are, let's say, the first owner of a CryptoKitty. And that has sparked the mind and interest of a whole host of people. They're beginning to buy these CryptoKitties, for significant sums of money. I think there was a sale of well over $100,000 a couple months ago. And it really just shows how in a blockchain-based ecosystem, you can have digital scarcity. We couldn't do that in the first and second wave of the internet, but now we have scarcity. So it doesn't make them, completely rivalrous, but we're getting pretty close to that, where somebody can prove that they own something online and nobody else owns it. And that's really interesting and something that sparked the imagination of a whole host of innovators. So since CryptoKitties has emerged, we've seen an explosion of marketplaces for the buying and selling of these digital goods. I think today we saw MLB release, a token-based game called MLB Crypto. And what's even more interesting is that once you have a non-fungible token, you can begin to mirror out really basic property rights. So you can prove, let's say, that somebody owns real property. You can prove that somebody owns intellectual property. And there's other token standards that enables you basically to model out sub-rights. So I can have a token that would represent a creative work, and then I can cryptographically tie to that token sub-tokens, which could represent exclusive or non-exclusive licenses. So we could see a world where you have something like a token for creative work and sub-tokens to represent rights of reproduction, distribution, display, public performance, and those can be allocated, and people can prove and actually know what licenses they have. So I think that's super interesting and something that a whole host of folks are working on.
Yeah, it is super interesting. I love the concept of one of the articles in our rundown for today has this remark that each CryptoKitty is a newly developed piece of IP. And you may not have thought about them that way before, but they certainly are. And you could certainly see other forms of IP. I mean, if you're selling CryptoKitties for $150,000 a piece, I guess that's nothing to sneeze at. But maybe different kinds of art will be monetized in this way too. For the time being, there's something. There's a wall you can write on. What is this thing called? Where you can keep writing over the artwork that's gone there before.
Oh, is that the trashy art one? The CoinDesk article?
Yes. Trashy art, I guess is what it's called. Hold on. Yeah, it's called Satoshi's Place.
Yes. Yeah. I mean,
Satoshi's Place.
So
paying Satoshis, the little increments of Bitcoins, to be able to basically create works of art on this wall. You can, for about the sum of equivalent to $65, you can take over the whole wall. It's a little bit nutty, and kind of as the person who created it at the end of this piece at CoinDesk says, basically we are keeping Bitcoin weird. I mean, I feel like it's just an experiment and some fun at this point, but you see how these adventures could lead elsewhere.
Yeah, absolutely. And I think that's the really interesting thing for a number of developers. That kind of vision of the first wave of the internet that was highly decentralized and really emergent. I think we're seeing that again in the blockchain ecosystem, right? We're seeing new modes of thinking, new ways of interacting with creative works, with published works, with financial goods and services. And that's interesting, right? I think the internet today feels a lot like cable television, with 4 or 5 companies that really control everything. The hope is that we can kind of move beyond that and get back to a much weirder and better place, like the first wave.
Yeah. How are your CryptoKitty holdings these days, Stefan?
They're thriving.
They're taking a beating.
Right.
They're private.
Yeah, what I find really interesting about this discussion, in particular when you get into the crypto kitty aspect of it, is how nicely it dovetails with sort of meme culture, which anyone who's been on Reddit or any other kind of large-scale message board on the internet understands. It's very visual, it's very irreverent, and it has a lot of layers of meaning that are not necessarily penetrable by outsiders. And so there's a kind of cultishness to it, and I don't mean that disparagingly. And if you think of it in those terms, you think about the passion of the users, you think about the sort of the codes they live by. They have sort of behaviors that they consider appropriate and others that consider transgressive. It kind of takes on this community feeling like a sect might, and every sect has to make a decision. Do we peter out? Do we give up? Or do we become a church? Do we become sort of a bureaucratized functioning unit? And it sounds like the technology we've been discussing today is at that threshold. Is it going to remain weird, as the Satoshi's Place founder put it? Is it going to remain sort of this cult-like outsider place, much like the internet early days Silicon Valley was, where you had really passionate insiders who understood the technology well enough to manipulate it and imagine where it could go? And then it became institutionalized and invited sort of normal people in to participate. And at that point is when this consolidation that Aaron alluded to took place. Is that going to happen with blockchain? It seems to me it's going to have to face the choice. Either it institutionalizes and subjects itself to governance norms, or it dissipates and stays decentralized. And if so, then maybe it won't be as much of a threat to the centralized power networks that currently exist. So at some point, just like the Bolsheviks, it's going to have to make a decision. Do we remain small and passionate, or do we scale up and institutionalize? And I think that's something that I find really interesting to think about as someone who's interested in governance and policy questions that arise from it. So fascinating discussion. I wonder where it's going to go when it scales up and institutionalizes.
Yeah, me too. I'm going to go ahead and put our second MCLE passphrase into the show, and it's going to be blockchain neutrality, because it's something that popped into my head as I was reading these pieces about dApps and laps. One lap that is in our discussion for this week is called Poketoshi. It's a way of paying Satoshis so that someone who is playing Pokemon on Twitch will you can affect the game. I'm not sure exactly how it works, but your payments impact what goes on in the game. And one of the things mentioned in that piece is talking about dApps on Ethereum, and how CryptoKitties have not been great for that blockchain because I guess of the way they were implemented, and they have dragged it down and caused delays and things. And there's discussion of users being required to pay Ethereum gas to have their transactions prioritized. So I guess that's just kind of a growing pain issue, Aaron, that you have to decide what parts of the transaction are done on the blockchain and off the blockchain so that it doesn't get bogged down.
Yeah, so you have to pay a transaction fee for executing any code on a blockchain. That includes, transferring an asset like a CryptoKitty. And blockchains are still kind of in the dial-up phase, so they don't operate a lot like other data structures where you can save things in a matter of, a fraction of a second or a nanosecond. And these networks can't process, millions upon billions of transactions like we've seen in other data structures. So that can cause some slowdown in the networks or kind of a backlog of transactions. So because of the explosion in CryptoKitties, we saw that temporarily happen to the Ethereum network, although there was over time, kind of the backup subsided. But it really points to some of these questions and some of the technical limitations of the technology today. Folks would call that scalability problems. And many, many top technologists are working to fix those, kind of to move us from the dial-up era of blockchain to the broadband era. But those folks that I've spoken to that are working on these problems think that they're solvable. It's just a matter of time before we kind of move and can increase the throughput, including using layer 2 solutions, which is kind of a networks or technology that sits on top of a blockchain that folks think can help scale these networks, including things like the Lightning Network in the context of Bitcoin, or the Rated Network, or in the context of Ethereum.
Okay, let's talk about just a couple of other things before we move to the end of the show here. One is there's a fascinating piece in Technology Review that you were quoted in, Aaron, about something called Augur. Getting into, of course, these technologies are going to be used for something that resembles gambling in one way or another. This one, Augur, not only has, our gambling law ramifications involved, but also our securities laws ramifications involved, because people are speculating, or maybe it's commodities laws more technically. People are speculating on the rise and fall of prices of cryptocurrencies using this thing called Augur. What is Augur and how does it work?
Yeah, sure. So, blockchains are, since they serve as a common data structure, are really useful for storing information about marketplaces. So we've seen a whole host of really innovative projects exploring how you can build marketplaces on top of Ethereum in particular. Augur is a notable example of that. It's a prediction market. So it's a marketplace that relies heavily on smart contracts, which are potentially autonomous. It's all open source technology, so anybody can download and kind of run or interact with the Augur network. And they can set up and maintain and potentially profit off of prediction markets. So prediction markets, for those who are unfamiliar with them, oftentimes allow folks to basically set a marketplace like, will XYZ win this election in the future? And then folks are able to basically bet or buy and or sell options related to that market in order to get a rough probability of the likelihood of that future event. So there's been some academic prediction markets that have been set up. There's also been some attempts to build commercial prediction markets, but they have kind of an uneven history in the U.S. The Commodities Future Trading Commission, the CFTC, has not looked favorably on prediction markets, in part because they kind of resemble gambling, and in part because there's some control that they'll be used to kind of undercut laws related to derivatives. And Augur just was set up and basically said, hey, we're going to use this technology, blockchain technology. We're going to enable folks to set up any prediction market that they want, and we're not going to stop it from occurring. And so once it launched, we saw a host of markets that were set up, including assassination markets, or markets that people could bet on the likelihood that somebody would die in the future. And so that may be kind of interesting, but I think as anybody who's seen Black Mirror, or anybody who kind of has a more dystopic view of the future, knows that if those markets become large enough, sometimes, the technology could actually effectuate some sort of harmful activity. So it raises a question, if these marketplaces, prediction markets, become popular, and if, certain jurisdictions like the US don't permit them, how do you stop them? How do you prevent, folks from engaging in this technology? And the answer is it's going to be difficult, right? But the law kind of seeps in at the edges, and there's always going to be somebody that you can hold responsible for it, including potentially the software developers or potentially the folks that are facilitating the creation and or execution of these marketplaces. But it definitely raises a whole host of problems when you have marketplaces not backed or run by any one person, but instead are largely or almost entirely operated via code.
Right. And back to the music industry, Analogies again, both the technology review piece and the post at Reason that we have in our discussion points for today. And you can read all of this great reading material that we have in the rundown for today yourself if you go to tagpacker.com/user/thisweekinlaw. This is episode 431, and all our stories are there for you to check out as well. Both the outlets that covered this analogized this to Napster and how it was difficult to, once there was no more Napster, and the various Napster clones were popping up right and left, and the code to do a similar service was out there in open source, and you couldn't put an end to it. It became very difficult to put an end to it. And the same thing, even if Augur somehow does not survive its legal challenges, the software to do this will go on.
That's the key, right? Yeah, it's a lot like, it's open source, right? So it's really hard to kind of put the genie back in the bottle once it's out. And even if let's say that, regulators didn't look favorably on something like Augur, and even if they brought an action against some of the software developers that started it, it's still out there, right? It's going to be really hard to contain it going forward. But I think the longer term trend is that we're going to see more and more of this, not just in the context of prediction markets, but maybe online gambling, right? Maybe with online file sharing. You could build entire really interesting censor-resistant, tamper-resistant, decentralized file sharing systems using a blockchain. So I think any area where there's kind of demand on the part of everyday folks to use a service, but yet there's laws that prohibit that, this is going to create a tension and a challenge, and we'll probably see some sort of blockchain-based solution to solve that.
So, Stefan, Augur is a prediction marketplace. Do you have a prediction about Augur?
I have the opposite of a prediction. I want to go back in time and just point out something that I find slightly ironic about the name Augur, which is that my understanding is that it comes from, this position that existed in ancient Rome called the Augur, which was essentially a priest who would look to birds to try to figure out whether to go into battle or not. And essentially the premise was if the birds behaved a particular way or flew in a certain pattern, it would indicate to the Augur whether they should advise the consul or whoever it was who was going to be going into battle, what strategy they should take, whether they should go into battle or wait. And I think that sort of morphed into this English word of auguring. But the irony there is that these priests, all they needed to do was perform the actual ritual of predicting, and they could actually impact the bird's behavior to get the result they wanted. So let's say the bird needed to eat in order for the battle to go forward. Well, you would starve the bird before putting the bird down to the feed, and then the bird would do what you wanted it to do. And you see a similar problem in these prediction markets, as Aaron alluded to. The line between predicting the future and causing the future to happen in the way that is financially rewarding for you is blurry. And you could very easily see this turning into a platform to manipulate events for financial gain. And I find tying that back to the origin of the word very satisfying in the dorkiest way imaginable. And yet here I am doing it with an audience. So
we're right there with you. I'm thrilled that you've done it. All right, let's look at something that may be a little less socially contaminatory. Let's look at how blockchain technology might actually save the social network arena. There are at least a couple of social networks out there that are trying to leverage blockchain technology. One is called Mind. It is on the Ethereum blockchain. And one is called Ono. They're both interesting in their own way. Ono does what Aaron was alluding to earlier in the show, that it actually has, now it doesn't say whether it's a cryptocurrency, it has some sort of like in-app monetary thing. I assume it's a cryptocurrency, I don't know, where you are paid digital currency for the quality of your posts, presumably for longevity. You can use those sorts of transactions to either trade with other users on the platform or etc. The other cool thing about it too is the founder, whose name is, I wrote it down. I'm not going to be able to say it right. It's Chinese. Shu Ke, maybe, is the founder of the Beijing startup Known Lab, and now this offshoot of it, Ono. She seems very concerned with the fact that the blockchain enables the company not to own the data. The users own the data because of the nature of this being a decentralized app. So she has no plans, the company has no plans to sell the data or leverage the data in that way. Thoughts about blockchain-powered social networks, Aaron?
Yeah, I think they're still pretty far away, but we're going to see a lot of interesting innovation and experiments with it. So it kind of feels like web vans to some of the on-demand delivery services that we see today. So, but I think the broad point is, right, if you can use a blockchain to kind of manage access to information that's oftentimes stored off-chain or stored personally, then we don't need, a Facebook or Twitter or some other social media platform to kind of manage and mediate that process. And instead, because we kind of know what the functions of these social networks are in broad strokes, we can begin to effectively open source them. Right, so we can open source something like Facebook so that it's not controlled by a handful of folks at Facebook Inc., but instead is owned and controlled by the end users. And the end users are able to, interact and use their data, keep control of their data, and potentially port that over onto other services that may emerge in the future. So I think that's super interesting and something that we'll see, but it feels a little early to me off the bat.
Yeah, definitely early days on all of this stuff, but particularly these. Any thoughts, Stefan?
A great author on this topic is a guy named Jaron Lanier. He wrote a book, I think it was 2012, 2013, called Who Owns the Future? That was maybe it's a little bit out of date now. I'm not sure, but it was an interesting book to read at the time. And I would just encourage people to read that book and get some background on this stuff. And he's going to say it a lot better than I would. So,
all right, good shout out to Jaron Lanier. All right, let's move on to our concluding material. First of all, we'll give you our tip of the week. If you did not know it, there hasn't been that much humor other than the CryptoKitties and the graffiti wall in our show today. But blockchain comedy is indeed a thing, and there is a blockchain comedy short film. We're not going to play the whole thing for you, but there is a trailer we could see a bit of.
Is he all right? He's a millionaire.
Do PayPal.
I don't have PayPal. You don't have PayPal?
Everybody has PayPal.
Oh, you don't have PayPal, Jesus. You should get PayPal. It's quite convenient.
We don't take card here.
This is the future of currency. Now listen, this is not intended as investment advice, but I'm going to give you some investment advice. Bitcoin is old news. Now, it's BitConnect.
Buy the dip.
I've just started accepting Doge, if that's any good to you.
Oh, I talked right over my favorite line of the thing where the guy says that he accepts Doge. It's kind of hilarious. It's a little short film about 5 minutes long. So buy the dip. Definitely check it out. It's particularly a nice chaser to our show today. Let's see. Our resources of the week. We have already mentioned Blockchain and the Law, The Rule of Code by Aaron Wright, our guest today, and his co-author Primavera de Filippi. We've got a couple of other things. We've mentioned OpenLaw, too, which is available at openlaw.io. If you are more interested in delving into the legal layer necessary to make some of the things that we've been discussing today possible. And Aaron is going to be speaking soon on September 6th, 2018. From 9 to 12:30 at the Roosevelt Hotel in New York at Blockchain 2.0, discussing 2018 legal and regulatory developments concerning blockchain. So we're thrilled that we've gotten a preview of all that today with you, Aaron.
Yeah, thanks so much.
We also we have an animal selfie of the week for you that has nothing to do with blockchain, but we can't skip it. We have to do an animal selfie each week. So here you go. All right, we're doing a lemur selfie this week. Coco the lemur was posted to Instagram taking an iPhone shot of Coco's cute mug. The reason I was inclined to do a lemur selfie this week was because we had a lemur emergency here in Orange County, California, where I live. Our little local zoo, the Santa Ana Zoo, had some prankster come and let all their lemurs out. And mostly the lemurs just took a nice stroll around the zoo. They didn't go anywhere. But whoever perpetrated this seems to have taken one of the lemurs with them because it was lost and the zoo was not sure if they were ever going to recover it. It's quite an elderly lemur. It's 30-something years old. It's one of the oldest lemurs living in captivity. And it showed up at a local hotel in an animal crate with a note saying, please return to the Santa Ana Zoo. So the good news is the lemur went back. Here we go. Anyway, the reason we do these animal selfies is there are frequently questions. And speaking of machines talking to each other, as to what sorts of rights non-human entities have, rights and responsibilities. And there has been litigation, interesting cases and discussions and commentary from the Copyright Office about ownership of copyrights by animals. And so we try and feature these animal selfies of the week every week. What do you think? Is my sprinkler going to start taking pictures and claim the copyrights, Aaron?
Probably at some point, yeah.
I think so too. When it gets into a dispute about what the refrigerator did, I'll let you know. It's been a huge pleasure talking with you today. I cannot wait to read your book. This is fascinating stuff, and I feel like we have learned a lot. I hope our audience has as well. I've thoroughly enjoyed our discussion. Thank you so much.
Yeah, thanks so much for having me.
And Stefan Szpajda, great to have you back on the show. Really appreciated learning about the history of auguring and everything else today.
Great to be back. And I think this marks 4 consecutive shows where I've somehow made a passing reference to either the Soviet Union, Bolshevism, or some related concept. And I think I'm just going to keep going. It's going to be on the back end, sneak it in one way or the other.
Yeah, please. Absolutely. It fits in too with whether we have to have a capitalist approach to our Internet of Things or whether they can share the wealth among themselves in some sort of way. I've really enjoyed going deep on all these issues with both of you today. There's so much more to discuss. I know folks in IRC have been saying all along that they're going to have a lot of reading to do to figure out all of the issues that we discussed today. We hope you will do your reading. And as you're cruising around the web, having done so and collecting more information in your daily lives, please let us know what you have found interesting. Give us a shout by email. Stefan is Stefan, that is Stefan, at twit.tv. I am Denise at twit.tv. Great way to get in touch or let us know on Twitter or Facebook or Google Plus what is on your minds. Either way, anyway, we love to have your feedback on the show. We'd love to know what you think we should be talking about, who you think we should be inviting on the show in the future to try and grapple with these really interesting issues such as we have covered today. We appreciate your suggestions and your jokes and your clips of things that we should watch. All of that stuff just keeps me going during the week when we're not doing the show. When we do the show, it's 11 o'clock Pacific time, 1800 UTC. We do that live. If you go to twit.tv, you can watch us live at that time. But don't worry if that doesn't work into your schedule. You can watch or listen to this show pretty much whenever, wherever, on what device you wish. And there are instructions about that over at the website. Our whole archive of shows is there as well. So dive on in, find those for yourself. And we'll be right back next week with more of the same. Until then, we hope that you take care. And we'll see you next week on This Week in Law.